So how many of you guys decide to learn how to trade just for the simple fact that you just want to make extra money? You probably heard, hey, yeah, you can make an extra 2, 3, 4, 5,000 a month, and it sounds a little lit. How many of you can relate to that story? Like, let's be real. Let's be real. So I got into trading because I was 100K in debt and the job just wasn't cutting it. I'm like, hey, listen, Uncle Sam, you not working for me, man. This time is money thing is not for me, man. Listen, the reason that doesn't work is because I only have 24 hours in a day, right? So that means I'm limited for how much money I can make. So Uncle Sam, you're not doing it for me, brother. Yo, let's be real. How many of you guys feel the same way? But out of the same amount of you guys that feel that way, how many of you actually were taught, or how many traders out there taught you and showed you how you can make that 2,000 to 5,000 or whatever amount you want to make within a month? No one's ever showed you the how, right? So in this video, I'm going to cover what a PIP is and how pips can affect the amount of money that you make when it comes to trading. Sometimes we neglect the little things. We forget the little things within the big picture, but understand a car cannot drive without a steering wheel. And the steering wheel is kind of like what that pip is to the market. Without the pips moving, you cannot drive the market. I'm not going to take too much more of your time. Let's get right into the information. What I want you guys to do is turn your attention to the prices that are on the right-hand side of the screen. In my last video, you guys learned that when understanding candles and what candles are doing, you understand that candles represent the fluctuation of price over time. So now let's talk about what that price is. You can think of the price as pips. What pips are, it stands for points in percentage. Well, anyone that speaks English will probably ask, well, what the hell does that even mean? And how does that even affect me? Well, think of it like this. That point in percentage is pretty much the unit of measure for the market. You probably have more questions, so I'll explain a little more. Let's take a deeper dive in the prices here. Let's first look at 1.26815. When looking at this number, typically the pip would be the fourth digit to the right of the decimal. So if you look at the decimal point, 1.26815, it'll be the fourth digit. In this case, it'll be 1. That number typically represents the pip. So when you're looking at a pair like GBP USD, the Great Britain pound versus the US dollar, it's typically the fourth digit. Most pairs follow this same idea where the pip is the fourth digit to the right of the decimal, but there are other pairs that don't follow that same idea. Let's just go step by step so you can understand the very basics for this specific pair. If I were to draw vertical separation lines to point out the pips, it'll make a little bit more sense. So when you're looking at this number, the pips would be considered 8-1, right? The 5 is considered a pipette. I'm gonna show you how to calculate the pips looking at two different sets of numbers, so it can make a little bit more sense. So on the screen, I have a set of numbers, a set of different numbers. So the exercise I'm going to do with you guys is calculate how many pips are in between each set of numbers. Now, I know it doesn't make sense yet, but trust me, follow along, you'll start to understand it. So if we're starting from the first number, which is 1.26815, if the market moves to 1.26825, how many pips did the market move? I want to turn your attention to those two numbers that I'm circling here. If you just focus on the two numbers here, you see the market went from 8-1 to 8-2. Now, if the fourth digit to the right of the decimal is considered a pip, then if it moves from 8-1 to 8-2, that means the market only moved 1 pip. Just kind of analyzing this, right? So 1.26815 to 1.26825. The only digit that changed was that fourth digit to the right of the decimal. So if you look at it, 1, 2, 3, 4, you know that's the pip. Now in this next example, if it goes from 1.26825 to 1.26925, how many pips did the market move? I'll give you a second to figure that out. Looking at the two numbers, it went from 8-2 to 9-2. That means the market moved 10 pips. The next set of numbers is 1.27925. You're probably thinking, well, those two numbers that you have separated hasn't changed. So does that mean it moves 0 pips? No, because guess what? If you look at the number before the 9, it's a 7 instead of a 6. That means the market moved 100 pips. So it's safe to say that the fourth digit is ones, the third digit is tens, the second digit is 100s, and the first digit is thousands. Taking it back to math a little bit, guys. I know a lot of you don't like math, but guess what? Sometimes you need it, right? And this is a basic example on how pips move. Given a new set of numbers, figure out how many pips the market has moved in between each set of numbers. From 1.25861 to 1.25961, as you already know, the market has moved 10 pips. If it goes from 1.25961 to 1.26961, the market has moved 100 pips. Now going for that from that same number back up to 1.27761, the market has moved 80 pips. So it's literally that simple. When you know how many pips the market has moved, you know how much your earning potential is. When trading leverage, we have something called a lot size. What is a lot size? A lot size is how much you have risk for a specific trade. Now there's different types of lot sizes. There's different sizes for lot sizes. This sounds crazy, right? But I'm gonna break this down for you very simple. We have 3 lot sizes, 3 different levels of lot sizes, and they all are pretty much different levels of risk. The lowest risk that you can do when it comes to lot sizes is the micro lot. Next is the mini lot, then obviously the standard lot. So now what does that mean? What does that mean exactly? You know, I'm sure you guys are probably thinking, right? The smallest that you can trade is a 0.01. A 0.01 counts as 10 cents per pip. So what that means is if you take a 0.01 lot size trade, then for every pip that the market moves in the direction that you have forecasted, then you'd make 10 cents. Doesn't sound like a lot, but this magnifies very fast. The scale for a micro lot pretty much varies between a 0.01 all the way to 0.09. The micro lot consists of anywhere from 10 cents per pip to 90 cents per pip. Now moving down to a mini lot. A mini lot is pretty much 10 times bigger than a micro lot. So if you look at it as 0.10, what do you think that's worth in the market per pip? Well, if you guys are paying attention, you got it right, because this is calculated as $1 per pip. 10 cents times 10 is $1. So what that means is if you go for a trade and the market moves 1 pip in your desired direction and you've put in a 0.1 lot size, that means you'll make $1 per every pip that the market moves. Mini lots can go from anywhere from 0.10 to 0.90. Now finally, a standard lot size. That is 1.00, and that calculates as $10 per pip. A standard lot size can go from anywhere from 1.00 to 99.00. Honestly, it depends on what broker you're using, determines how high of a standard lot size you can use. But I'm just giving you the very basics, right? What does money look like in this case? So just for your further understanding, there's only 2 directions that the market will ever go. It's either up or it's down. That gives you a 50-50 chance to win a trade now, doesn't it? Therefore, it's either you buy or you sell. I'm sure you've heard the term buy when the market's low, sell when the market is high. Well, how do you know when the market's low or high so you can either buy or sell? You know, this is what we'll learn throughout this series, is how to look at and analyze the markets to know the best positions to take. Let's talk about how much money you can make if you're right and how much money you can lose if you're wrong. So let's say for your first trade, you go in for a buy. So that means you're looking for the market to go up. Based on your analysis, you know, you see the market going up, therefore you see it going bullish, right? If you guys read my previous video, bullish means up, right? You decide to take this trade and you put in a 0.05 lot size. If the market goes up by 10 pips, how much money did you just make? $5. Doesn't sound like much, right? But you know, we're taking baby steps here. Next scenario, let's say you decide to take a sell and you're feeling real confident. You feel as though you want to do your full risk. So let's say you end up doing a 0.30 lot size. The market goes down by 100 pips. How much money did you make? Yep, $300. In trade 1, if you did a 0.05, how much dollars or how much cents is that worth per pip? Well, we know that a 0.05 is considered a micro lot. In this case, it'll be considered 50 cents per pip. So you'd make 50 cents every pip that the market moves. So if you make 50 cents per pip and the market moves 10 pips, you made $5. In trade number 2, if you went for a sell at a 0.30 lot size, we know that that's a mini lot. Now a mini lot goes by dollars per pip. So in this case, it'll be $3 per pip. And if the market goes in my direction, which is down by 100 pips, you do the $3 times 100 pips, which gives you $300. Now trade scenario 3. In this scenario, you put in a sell position for a 0.50 lot size. We know that that's a mini lot. Now, if the market goes up by 5 pips, how much money did you make? Well, that's a trick question, right, guys? Because we know that we put in a sell, but the market went up. That means we lost money, right? So how much money did we lose? It'll be the $5 because we put in a 0.50 mini lot. So that means that's $5 per pip. And if the market went 5 pips, that means we just lost, you guessed it, $25. Simple enough, right, guys? Let's go to trade scenario 4. Now, in this scenario, you're going for a buy at a 0.09. Now, if the market goes down by 15 pips, how much money did you make? Well, if we're buying with a 0.09, we know that's a micro lot, which means 90 cents per pip. But we went in for a buy and the market goes down by 15 pips. So that means we lost money. How much money did we lose? It's going to be your 90 cents times the 15 pips. So that's only $13.50. Now, in this scenario, you're feeling extra confident and you decide to take a buy for a 1.00. Now we know a 1.00 is a standard lot size. The market goes up by 300 pips. How much money did you make? Well, it looks like you won because you went for a buy and the market went up, right? So how much money did you make? Being that a standard lot size is $10 per pip. So you would do $10 times 300 pips. It sounds like you made a whole lot of money, right? You just made $3,000 in that one trade off of that 300 pips. Now that is the power of trading. The point of this example is not to show you if you just risk high, you'll just make a ton of money overnight, because understand that you can also lose. So the last thing you want to do is over risk your account. See, this is where true risk to reward management comes in, because you don't want to be in that position where you feel very emotional when it comes to the charts. Pips are going to determine your safety factor as well as your target goal, your profit target, determining how much you're willing to lose versus how much you're willing to gain. If you don't understand pips, you would not understand the money side of trading. Drop in the comments if I covered something that you were struggling with in the past. You have no idea what a lot size is, and maybe you just learned something. What I want to urge you guys to do is go, do a little homework. Practice figuring out how much money you'd make or lose based on how many pips the market has moved. With practice comes results, guys. Me giving you guys this homework is me holding you accountable to the information that I'm going over today. Now, thank you guys for hopping on. I'll see you guys in the next video.